Today, we're going to be exploring equity income investing,
Okay.
but we're kind of going a little bit beyond just the typical focus on dividend yield.
Right.
You've provided us with two pieces from Johnson Asset Management to kind of guide this deep dive.
Yeah, I think it's really interesting how these documents kind of challenge the traditional approach.
Yeah, and that's what we're going to look into today.
Okay.
So let's start by understanding the role of dividends in the bigger picture of long-term returns.
Yeah. So, historically, dividends have been a powerhouse. They've contributed significantly to equity total returns.
Mm.
And you see that impact become even more pronounced when you look at longer periods.
Yeah.
For example, Johnson Asset Management points out that over the past 2 decades,
Oh.
dividends have actually represented over 50% of the income generated by a typical 60-40 balanced portfolio.
Wow, that's significant, especially I think in today's environment when you look at maybe traditional fixed income yields.
Right.
That might not be meeting investor needs as they have in the past.
Absolutely.
So having that dividend component is really crucial.
Yeah, and it's not even just about that immediate income either.
Right.
Dividend growth very often outpaces inflation, so it can act as a potential hedge against rising prices. And that, of course, is a crucial factor for anybody who is trying to maintain their purchasing power.
Okay, so let's shift gears a little bit and talk about dividends as a signal of quality.
Okay.
What do you mean by that?
So think of it this way. A company that consistently pays dividends is often a sign of stability.
Okay.
It usually means they have a really robust balance sheet, and they're able to generate consistent earnings growth. And that's what allows them to keep those dividend payments coming.
So almost like a vote of confidence from management if they're consistently paying those dividends.
Exactly. And Johnson Asset Management really emphasizes that companies that are focused on sustainable dividend growth are often rewarded with higher valuations in the market.
Interesting.
Yeah, the market recognizes that commitment to shareholders.
Right.
And interestingly enough, their research also reveals that historically, dividend-paying stocks have outperformed non-payers
Okay.
with less risk.
So you can actually boost returns and potentially mitigate some of that risk
Exactly.
by incorporating these types of stocks.
Yeah.
Now, I know the documents also caution against focusing solely on dividend yield.
Yeah.
It's important to look beyond the surface.
Absolutely.
So kind of break that down for us a little bit.
So while a high dividend yield might seem very tempting at first glance, it's really important to understand the underlying story.
Right.
Sometimes a high yield can actually be a red flag. It might potentially signal issues like low earnings growth or high leverage, or even an unsustainable payout ratio. So Johnson Asset Management introduces this concept of shareholder yield. And I think this is really interesting.
What is that?
So think of it as a broader lens for evaluating shareholder returns. They argue that long-term equity returns are fueled by fundamental cash flow growth.
Okay.
So that means looking at earnings and dividend growth, not just changes in valuation.
Okay.
Shareholder yield expands the view to include not only the dividend yield, but also dividend growth, net share repurchases,
Got it.
and even net debt issuance.
So we're kind of taking the blinders off and looking at the full picture of how a company is returning value back to shareholders.
Precisely.
Instead of getting so fixated on that one number, the yield.
Exactly. And so they propose that focusing on shareholder yield, which considers all of these factors, is a more insightful approach than simply chasing the highest absolute dividend yield.
Got it.
So taking a broader perspective.
Interesting.
Yeah.
So shareholder yield kind of offers us this more holistic perspective.
Right.
But how does Johnson Asset Management actually identify companies that fit this model?
Yeah.
They emphasize a quality-focused approach.
Right.
Can you elaborate on that for us?
Yeah, so their definition of quality goes beyond just looking at financial numbers. They really delve into 3 key areas:
Okay.
competitive advantage, balance sheet strength, and prudent capital management.
So let's break those down a little bit, starting with competitive advantage.
Right.
How do they assess that intangible edge a company might have?
Yeah, so they start by looking at profitability,
Okay.
specifically a metric called CFROIC,
Okay.
or cash flow return on invested capital.
Mhm.
A high and increasing CFROIC indicates that a company is using its capital efficiently
Right.
and generating strong returns.
So it's not just about being profitable, it's about being smart with how you're using your resources.
Exactly.
Okay.
They also analyze the stability of this profitability over several years.
Oh.
They want to see consistent revenue, profit margins,
Okay.
earnings, and returns.
So they're looking for businesses that can kind of weather different economic cycles
Exactly.
without those dramatic swings in performance.
Yes.
Okay, that makes sense. Stability is key,
Right.
especially for income investors who are relying on those consistent dividend payments.
Absolutely.
Now, what about balance sheet strength?
Right.
Why is that so crucial in their assessment?
So a robust balance sheet is really important because it acts as a shock absorber during economic downturns.
Okay.
Johnson Asset Management prioritizes companies that have low financial leverage,
Uh-huh.
meaning they haven't taken on excessive debt.
Right.
High debt levels can actually magnify losses during tough times and limit a company's flexibility.
So it's about having that financial flexibility to navigate those challenges without jeopardizing the core business.
That's right.
Okay.
They also emphasize the ability to self-fund capital and investment needs through internally generated cash flows.
Okay.
This shows that a company can invest in its future and meet its financial obligations without relying so heavily on external financing, which can be risky during times of market stress.
Makes sense.
Yeah.
Okay, so let's talk about prudent capital management.
Oh, okay.
That's the third pillar of their quality assessment.
So it's about making sure that a company is making smart decisions with its capital. They start by evaluating the dividend policy, looking for a sustainable payout ratio.
Right, so they want to see that that dividend is well supported by earnings
Exactly.
and has the potential to grow over time.
Exactly. And they also analyze the total payout yield and the shareholder yield that we were talking about earlier. And this broader view helps them to identify companies that might be masking unsustainable dividend policies by relying too heavily on debt or issuing more equity.
So they're really trying to suss out that genuine commitment to returning value versus kind of these short-term maneuvers that might not be sustainable?
Exactly.
Okay.
Their assessment also includes a thorough review of the company's track record in share repurchases, debt reduction, and merger and acquisition activity.
Got it.
So they want to see a history of strategic decisions that genuinely create long-term shareholder value.
It sounds like their due diligence process is pretty thorough.
It is very thorough.
They're not just ticking boxes.
Yeah.
They're really trying to understand if a company can create and sustain value over the long run.
Absolutely.
All this talk about quality sounds great.
Right.
But how does it actually translate into portfolio performance? Can they back up their claims with actual results?
So according to their track record, yes. Johnson Asset Management claims that their quality-driven approach has delivered strong risk-adjusted returns and provided downside protection during market downturns. They say that their equity income fund has consistently outperformed benchmarks while exhibiting lower volatility.
Interesting. So their approach aims to achieve both capital appreciation and that consistent income generation while minimizing the risk of permanent capital loss.
Exactly. That's the idea. Balancing growth and income, but prioritizing the preservation of capital.
So we've covered the why and the how of Johnson Asset Management's quality-focused approach.
Right.
Now, I'm kind of curious to see how this actually plays out in building a portfolio.
Yeah.
Can you give us some examples of companies that might align with their criteria?
So it's important to remember that their actual portfolio holdings are constantly evolving based on their in-depth research and, the market conditions. But we can kind of get a sense of the types of companies that they seek.
Yeah.
Imagine a company that dominates a growing industry, has a history of innovation, and consistently generates high cash flow returns on invested capital.
That sounds like a recipe for a strong competitive moat.
Exactly.
Okay.
They would also likely favor companies with low debt levels, consistent ability to fund their operations and investments internally.
Makes sense.
On the capital allocation front, they'd be looking for sustainable dividend policies, consistent dividend growth, and a track record of strategic decisions, things like share buybacks or acquisitions that enhance long-term shareholder value.
So it's about finding companies that aren't just performing well today, but have the potential to keep delivering for shareholders in the long run.
Exactly. Their focus is on quality, and their framework helps them to really rigorously assess a company's financial health, competitive position, and capital allocation strategy. So that's what guides their decision-making process.
This all sounds very compelling. But are there any potential downsides or challenges to implementing this type of quality-focused approach?
Yeah, of course. Identifying truly high-quality companies requires a lot of research and analysis.
Right.
It's not a simple task, and it can be pretty time-consuming.
And I imagine these sought-after companies often trade at premium valuations.
Right.
Does that mean accepting lower initial dividend yields?
That is a valid point, and investors need to really weigh the potential for long-term growth and stability
Uh-huh.
against the desire for that immediate income.
Right, that trade-off.
Yeah, it's a balancing act.
Are there any other factors to consider?
Well, it's important to remember that the market's perception of quality can shift over time.
Okay.
A company that is considered high quality today might face unforeseen challenges tomorrow.
Of course.
So this means ongoing monitoring and portfolio adjustments are crucial.
So while this quality-focused approach seems promising,
Right.
it requires diligence, patience, and a long-term perspective.
Absolutely. It's not about quick wins.
Right.
It's about building a sustainable and resilient portfolio for the long haul.
Well, this deep dive into Johnson Asset Management's approach has been incredibly insightful.
Yeah.
They've certainly challenged conventional wisdom, emphasizing the importance of quality over simply chasing yield.
Yeah. I think their research and track record really suggests that this approach can lead to more consistent, resilient, and potentially rewarding outcomes for equity income investors.
As with any investment strategy, it's important to do your own research
Of course.
and see if this approach aligns with your personal goals, risk tolerance, and time horizon.
Absolutely.
The insights we've discussed today can be a great starting point for building a more robust and informed investment strategy.
Yeah, I agree.
Well, thank you for joining us on this deep dive into equity income investing.
My pleasure.
We hope you've gained valuable knowledge and a fresh perspective on building a resilient and rewarding portfolio.